Hello, in this video I'll be covering an introduction to limited company accounts, specifically focusing on the different types of shares that you need to know for the AQA 7127 specification. So there are four types of shares that you need to be aware of. There are more than four, however it's just the four that you need to be aware of for AQA, and they are ordinary shares, premium shares, a rights issue, and a bonus issue. So the first one, which is ordinary shares, these type of shares are the standard type of shares. Okay, shares that are at the base price. So a company that is listed, every company that is listed on any stock exchange will have a base price for a share. Okay, so if you take, for example, ASOS, okay, today's date, which is the 18th of May 2020, the current price for an ASOS share is £27.13. Okay, £27.13p. But the base price of the share is 3.5 pence. So when ASOS decided to become a listed company, okay, they would have valued their shares at 3.5 pence each. Okay, obviously now they're significantly higher. Okay, however, the base price is 3.5 pence. That is the ASOS PLC. The ordinary share value is 3.5 pence per share. Okay, so for every company that is listed, they will always have a base price and they will have an actual market price. So this is your market price and this is your base price. Okay, this is your ordinary share value. So the first type of share is an ordinary share, which is where the share is valued at the nominal price, and something insignificant. That's what the nominal value is. A nominal price, something very small, something insignificant. Okay, and when a company sells a share, the nominal value, so each share that is sold at 3.5 pence, all of the, let's just say they sold 10 shares, okay, and they sold them at 5p, for example. Every share, every 3.5p of a share will go into the category called share capital. Okay, so imagine ASOS, if they sold shares at 5p, the 3.5p for every share will go into the pool, which is known as share capital, and the extra 1.5p will go somewhere else. Okay, and I'll talk you through that in a moment. So for example, a company issues, i.e. sells 100,000 shares at a nominal price of 15p per share. What is known as the ordinary share capital. Ordinary shares, ordinary share capital. Capital meaning, investment. So they've sold 100,000 at 15p, which means they will receive £15,000 of investment, and that is known as ordinary share capital. Okay, that's all ordinary shares are. Okay, it is shares that are sold at the base price, the nominal price, or par value. Okay, so another word for nominal value is par value, the base price of a share. Okay, and I mentioned with ASOS, their base price is 3.5p. Their market price is £27.13. Okay, and every business will have a market price and every business will have a base price. Okay, so what is the difference between these two? Well, ASOS listed the companies at 3.5p. Okay, that is the base price for the share. They obviously are being sold at much higher. The difference between the two, anything above base price is known as a premium value, okay, which is the next type of share. What happens if you sell a share above the base price? Okay, and that is known as a premium value share. So premium shares is the second type. Premium shares that are shares issued above the nominal value. Okay, so like I said, a business will set a base price. If it is sold above that nominal value, above the par value, then they are known to be premium shares. So for example, shares that have a nominal value of £1, they may be issued at £1.25. A business may decide to sell them at higher than the nominal or par value. Okay, and the amount above the nominal value is treated as the share premium. Okay, that is treated as share premium, and the nominal value is treated as share capital. Okay, so £1.25 we're selling them for. That is the selling price, but there is a split. Okay, the £1 is the nominal value, the base price, and the extra 25p is the share premium. So you could call this £1 is the ordinary share value, and the 25p is the share premium. That's how it will look on a company's books. Okay, if you think about a sole trader who has, capital, which is opening capital plus profit minus drawings equals closing capital. Well, for a company that has limited liability, on their financial position, you have ordinary shares. You have share capital and you have share premium. Share capital, share premium. Share capital is how much cash has been generated through nominal value, and share premium is cash that's been generated through selling shares at a premium value. Okay, so we've got an example here. A company has sold 65,000 shares at a nominal price of 50p plus a premium of 20p. What is the total revenue that they have gained? What is the nominal value that they have gained, and what is the premium value? So can you work out the total, and can you work out the split? Okay, so I've got the answers up here already worked out. So 65,000 shares, they have been sold, can't find my mouse, 65,000 shares have been sold at 70p. So total revenue is 45.5. If we split, the nominal value is 65,000 shares at the base price of 50p. So 32,500 is nominal value, and 65,000 shares at the 20p premium value is £13,000. And if you add the two together, you've got 30 plus 10, 40, 500. Okay, so you have the total capital is 45.5, but that capital is split between ordinary share value, share capital, and share premium. Okay, share capital and share premium, nominal value, premium value. The next type of shares is what is known as a rights issue. And a rights issue is when a company will issue shares. They will give the option to shareholders, existing shareholders, do you want to buy any more shares from us? Okay, and it's usually done based on how many shares existing shareholders have. Okay, and one of the main benefits of doing a rights issue is you are not selling shares to the public, you are selling them to existing shareholders, which means you are not diluting control. Okay, if you were to sell shares to new shareholders, you will lose more control, okay, in terms of decision making. However, if you choose to sell them to existing shareholders, well, whatever existing shareholders decide to do, it's going to continue anyway. So it's better in some sense to sell shares to existing shareholders than opt in for new shareholders, simply because the more shares that go on the exchange, to new shareholders, the more control you lose. Okay, so better to sell them to existing shareholders, and that way decision making is not being diluted. There are other benefits. There are less costs. It is cheaper, and also you don't need any consent. If you are going to sell shares on the stock exchange to new shareholders, you need consent from existing. So there is another benefit there, and it is also cheaper to do a rights issue than to do a full new issue of shares on the stock exchange. Okay, so that's basically how it works. You're just selling shares to existing shareholders. They are not new. Okay, let's have a look at an example. So you have a company that has ordinary shares of £140,000. This is what they have already. They have premium shares of £35,000, and these are at 5p. Okay, so 20p, lots of 20p's, that equate to 140,000, and lots of 5p's that equate to £35,000. Okay, and this is simply what a company has already so far to date. This particular company decides to have a 2 for every 5 rights issue. Okay, and they are selling these shares to existing shareholders for 20p. So what effectively they're saying is, look, existing shareholders, we are willing to sell 2 shares to you. For every 5 that you have, we'll give you 2, and we'll sell them to you at 20p. Okay, so how do we actually tackle this particular question? Right, the first step is you need to find out how many shares does a business have already in issue. So you take the £140,000, or the ordinary share value, and you divide it by 20p. And this gives you 700,000 shares. Okay, that's how many shares they have in issue. Then you use the quantity, the 700,000 shares, and you divide them by 5 times by 2. So we are doing we're issuing 2 for every 5 that you have. So 700,000 divided by 5 times by 2. So a company is willing to issue 280,000 shares. 2 for every 5 that you have. So if a shareholder has only 5 shares, we're going to say to them that, look, we're going to give you 2. If a shareholder has 10 shares, we'll say we're willing to give you 4. If an individual has 15 shares, we are willing to give them 6. Okay, and basically in basic math terms, you just divide 140,000 divided by 20p, work out how many shares you have, and then divide it by 5 times by 2, and that will give you the quantity that the company is willing to give out. Okay, or you can do 700,000 times by 2 over 5. Students tend to find that to be easier in terms of calculator. So we are issuing 280,000 shares, and we are issuing them at 20p. Okay, so the same price as an ordinary share. We're not selling them for anything above premium. We're selling them at the base price. So 280,000 times by 0.2, which means we are going to get £56,000 in cash. Okay, so this is a 2 for every 5 issue. Another scenario. So we have a company that has £100,000, 40p is the nominal price, the base price, and we have £5,000, and that is because we must have sold shares at a premium. This particular company decides to do a 1 for every 4 rights issue, and they are sold at 42p, i.e. they're sold at premium. Again, step 1, let's find out how many shares they have. 100,000 divided by 40p, they have 240,000 shares. We are going to do 1 for every 4. So for every 1, we are going to issue 4. So 250,000 divided by 4 times by 1. So 62.5 we are willing to give up, or 250 times by 1 over 4. Okay, we're willing to give up a quarter. We're willing to issue a further quarter. £62,500 shares at 42p. Where's my mouse gone? So we should get £26,250 in. Okay, £25,000 of that is ordinary share value, and 1,250 of that is premium. Again, 62.5 lots of 40p's, and 62.5 lots of 2p's. 62,500 times by 40, and 62,500 times by 2 will give us the premium value. Okay, see part 2 for the next type of issue.